Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of June 1st, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to look at some strategy considerations and really kind of calling out that position sizing really can be a universal life raft when it comes to your trading strategies. And it's something that I think a lot of traders really don't take into account. And so we're just going to touch on what the heck is position sizing and the personal perspective on why we think there's a lot of merit and credence that should be given to position sizing in this week's episode. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, I keep track of this because I put the titles on every episode in my storage unit. But basically, this is the 220th episode. That is 220 weeks that we have put out an episode of some kind, whether or not we both appeared on it or one of us. Well, I guess we don't have any of that. None of us appeared, but 220 weeks. And I started this whole thing to really kind of cover a gap that I kind of saw in the video content and trading content that was out there, or lack thereof, in the world. And so, one of the things is, it's one thing to cover strategies and things like that, but I think what Viper and I try to kind of do in a lot of these episodes is just connect with you, the viewer, and give kind of our personal take on things so that, hey, real people can do this too. There's not some magical, mythical thing that you have to be a good trader, be a good investor, other than you have to genuinely be interested in it. And so along those lines, I constantly struggle with myself and my trading record, if you would. When things get kind of bad, I like to think, oh my gosh, what am I doing? Is this all a big mistake? And when things are really good, I think, oh my gosh, I'm on top of the world. I'm the king of this. This is amazing. This is easy. And in both times, I try to always take the counterpoint to that, and I'm kind of constantly trying to look and look for or research, like, okay, if when I'm feeling on top of the world, I go, what can go wrong? And I like scour the internet, almost like bias, confirmation bias, but I'm looking for confirmation bias in the negative way, I guess. And so far things have been going pretty well in my trading for this year, and I really wanted to start looking at, okay, why should I not do this particular strategy? And so I started lately I've ended up getting assigned a few different shares and taken longs on them and then go to convert them. So I really spent some time Googling or searching for why the wheel strategy is the worst strategy, or why a covered call is not worth it. And did I find some interesting videos. I won't link any of them, so you can go out yourself and look for them. But one underlying thing that I thought was missing from a lot of those videos is they really talked about blowing up your account, or, losing all of this, or, this might work fine 80% of the time, but 20% of the time you're going to lose. And that's that 20% of the time that's going to wipe you out. And the points they made were all kind of valid, but a lot of the videos neglected to talk about position sizing. There's a few of them that alluded to it, and I just want to really, really, really emphasize this because it's something we call out on the show, but to be honest, I don't know that we give a lot of credence and time to it. And that is, position sizing is when you go to take a trade, how big is that trade relative to your portfolio? How much buying power are you consuming? How much capital are you tying up? And we talk about capital efficiency and things like that. But one of the biggest things that keeps you alive in the trading world is keeping that position sizing small so you can have many, many diverse trades, many, many incremental trades on, but no one of them can sink the whole ship. So I guess think of it kind of like the way they designed a lot of the early cruise ocean liners, right? The Titanic was supposed to be unsinkable because it was supposed to have all these different compartments that they could seal off. And the fact that there were so many different compartments was supposed to be what made it buoyant. Now, maybe it's a bad example because that ship sank. But I guess where I'm kind of going with that is, a decent thing to target is a position of, around 1 to 2% of your total portfolio. So if you have $100,000 portfolio, you're only putting a trade on at around, $1,000 or $2,000. And if you only have $1,000 portfolio, your position sizing is probably more like 10 to 20 bucks. And that I think is kind of important. Before I jump into some of the disputes or some of the things in some of the videos, Viper, I don't know if you have come across, I know recently we've touched on a lot of your different strategies that you had on your earnings. And I think you explicitly called out, hey, look, here's my win rate. I'm doing pretty good, but there's this one trade, Lululemon, or I think it was Lululemon. I don't know,
Yep.
one of them that just blew up on you. And your position size was 5x what it was everywhere else.
Yep. Yeah. And I mean, I would say, as I covered over those couple episodes where we talked about that, this whole experiment. I mean, at this point, I don't really want to. I mean, it is an experiment, but I mean, it is settling into an actual regular routine, which is exactly what I was hoping to set out for. But we'll call it the experiment. That this whole experiment with the calendar spread strategy, earnings calendar spread strategy, has really been an important piece of I don't know, confluence of market behavior, and specifically because of that fixed position size, and the 5x position that blew up, and just that reaffirming the need for it. And what started as like, I just want to get clean data collected out of this. So I'm just going to, and so in my head, it was more of that perspective. It wasn't really relative to positions or account size or anything like that. It was more of like, if I want accurate statistics here, I need to do the same exact position size over and over and over again. But it's quickly turned into realizing the impact that it has psychologically in relation to the entire account portfolio, because now that the wins are actually proving out in my favor, even though some lose, the ones that lose, I'm much, much, much more relaxed about it. And I'm also, as is key benefit, which we'll go over in a future episode, because there's some plays setting up this way. When it's losing, I just let whatever's left of the position, I'm very comfortable letting it ride, because number one, the win rate is in my favor. So that was a loss. There's 2 or 3 more wins in ratio, in coming down the line. But also the position size. Well, that one's a loss. Now combine that mentality of I have more wins coming statistically, and I'm going to continue the same exact position sizing. So it just brings this whole healthy psychological aspect to it, which is really starting to take hold, now a month into this experiment. So it's not an instant grab thing, but it's a muscle memory, I think.
Yeah, no, that's really spot on. And it takes a lot of anxiety away, as you mentioned. You say relaxed. And when you know that, hey, this one thing isn't going to make you or break you, it's just an incremental thing. Some of the examples I kind of want to draw to is my portfolio. I have a wide range of, sometimes I'm long positions, sometimes I'm short positions, based on which options I sold. Did I sell the call? Did I sell the put? Did I sell a strangle and get assigned on the high end? Did I sell a strangle and get assigned on the low end? And if we look back, just even of recent trading, we have been in, I think one of the Blockhead Traders has termed this our Kangaroo Market. because we're up, we're down, we're all around, and it changes in an instant, right? Back in April, when Liberation Day came, the markets just absolutely tanked, and we were recovered from there. And just a few weeks ago, like last week, I think it was on a Friday, the president, was like, "Oh my gosh, the EU, we're going to give them 50% tariffs starting June 1st." And 3 days later, he said, you know what? We're going to go ahead and wait until July 9th. And then the market shot up again. And each of these days, I mean, we're talking 1, 2, 3% movement in these massive indexes. And then after that, the federal court had come out and said, yeah, so the president doesn't really have the authority to make these sweeping tariffs, and off to the races the futures go. And the one thing that is for certain in all of this market direction and magnitude and all of that stuff, the one piece that I can promise you will be the case no matter who you are is you will not be able to predict when, where, or how far the market is going to go. That's just a certainty. Is the uncertainty is the only certainty. And I really think getting around that is kind of what protects you. And it's that contain each position to a small amount of your portfolio so that if it goes up, if it goes down, right, you're still going to get the win, but it's not going to blow your account up. Now, the one thing I want to kind of call out in some of these videos, because I almost feel like I want to refute some of the facts that they were bringing up or some of the points that they were raising. But of course, you didn't see the video, so I can't, you can't give that other side of the argument as well. But one of the biggest things that I actually think is pretty valid, and it's something I myself haven't really cautioned against, is I always say, oh, are you okay with assignment? Are you okay with assignment? But really think about what that assignment means for your account. And this is definitely something that's in that video that I said, you know what? He's right. I don't really communicate some of this stuff. So let's take, for example, you sell a put on something that is a $100 underlying. You sold it at the 100 strike. So we're going to use easy numbers here. And so if that strike, if you get assigned that, $100 strike, that's 100 shares that you have to buy for $100 a piece. So that's $10,000 in capital. And it's important to remember what that notional value is that you're buying. Because that means in most accounts, right, you're going to have to put up $5,000 in buying power, and $5,000 of that's going to go on margin, and that can be really dangerous for you if your account is expecting to have that capacity or that margin. Because if that underlying declines further, the buying power or the margin coverage and stuff like that will change by your brokerage. And so while it might have only cost you, $1,000 to sell that put, right, to collect the money and only pony that up, once you get assigned, you can't forget the fact that that is a $10,000 notional value, and you really should be in, if you're keeping your position sizing and you want to go like a cash secured put, you really have to have that $10,000 to squirrel away. Otherwise, if you put all this stuff on margin, when that stock declines more, your brokerage is going to say, hey, you know what? You don't have as much cash as you think you have, so you got to pay up or I'm going to liquidate this position. And I think that's very important, that when we talk about position sizing, if it's option selling, you really got to take into account that worst case getting assigned and what is that capacity of the buying power that it's going to consume. Another point that I had come across that it really rang true to me, and something that I don't think we've really talked much about when it comes to the wheel strategy. Because as I mentioned, I was really kind of focusing on, man, what's all the dangers of the wheel? Go tell me why the wheel's a bad idea. And that's really what I was looking for, and kind of trying to find those counterpoints and counter arguments. And the one video that I watched actually went for a very lengthy time saying the wheel is a very confusing strategy. And I thought, well, how can this be a confusing strategy? It's a very straight, simple strategy, right? You sell the put, you get assigned, and you sell the call, and you wheel out of it, and then you rinse and repeat. And the point that they were making, which I never really gave thought to, so I guess this shows that some of the benefit of kind of looking for the counterpoints to your perspective or your biases, was when you sell puts, when you sell calls, right? Whenever you sell options, you have an exit strategy or a time frame of the strategy that you're doing, right? It's a short-term strategy. The option has an expiration date. When that expiration date comes around, you have sold it. It's worthless. That's what you want to have happen. And so your mindset is all on the short term. Now, when you take assignment on an option trade, right? Now you have the shares. And a lot of people say, well, hey, that's all good, well and good, because now you own the shares. And a lot of people lose sight of the fact that, well, what's the stop now? What's your get out? Now, all of a sudden, typically when you own shares, you're talking a much longer term strategy. The fundamentals of the company, this shares are going to appreciate, so much over time because of X, Y, or Z. You don't really have the mechanics laid out, or at least not how I've ever heard a lot of the wheel explained from a strategic standpoint to a long-term or short-term. And so you're almost switching your strategy per trade to say, yeah, this is my short-term trade. And if I get assigned, yep, I'm long-term now. And I think that that's a very fair statement and something that really rang true to me because Viper, even you got assigned on one of those things that we've ridden to zero. I still have my over the counter coupons for FCB, but there's other underlyings that I've been assigned that have pretty much gone to zero, and that is one of these areas where, yeah, my strategy is to sell calls, but my strategy is to sell calls only when the underlying is above my assignment price. What if it never gets there, right? And that's happened to me. Like, it's true. I didn't really have an exit strategy, and so I still have those things in all the positions that basically never got wheeled out. And so these are wheels, I guess, with flat tires. And I guess I never really reflected on that aspect of it, but it's never been a problem in my portfolio because of position sizing. To bring it back around to that position sizing is, yeah, I carved out this, and yes, it was, a certain percentage of my portfolio, and it went to zero, and I'm still trading. So con there is, I definitely see what they're saying. It's a strategy that didn't really have an exit plan, and it turns out I didn't exit because I stuck to the plan, which I guess it's not a good thing or a bad thing, but also it didn't sink me because I kept it within my position sizing.
Yeah, I certainly think that's important, and I've felt it as well. Of just the mental block, the stigma, the confirmation bias, if you will, directional bias, I guess is the better word. That is good to get into these plays to snap you out of. Like you said. Even on the calendar spreads, there's been setups where the way certain things happen, I'm starting to realize, like, a best case scenario, I am potentially bearish for a minute and then bullish after that, depending on how it plays out. And so just in general, going through that process, while it doesn't sound enjoyable because it sounds like kind of you're kind of have this bipolar personality, but at the same time, in all of the years of experience now, kind of have to be a little bipolar to participate in certain aspects of the market, because the market really doesn't care what you think is going to happen. It's going to play out in a particular direction, and then it's going to hit a particular event, reversal scenario, and it's just going to flip around. And if you're not ready for that to happen, then you're going to keep chasing, and you're going to get stubborn, and you're going to go, and just start grinding away money. So in that sense, I think it's good to kind of be in those positions where you have to make a mental switch on a dime of, I'm no longer that, and now I'm this. And it just helps overall. It helps that mental state and whatnot. Again, it's very uncomfortable at first, but it's the training the muscles, getting that muscle memory in a position that is more aligned with the irrationality of the market, if you will.
Yes. And the market can certainly be irrational. I think the famous saying is the market can stay irrational longer than you can stay liquid. So, one last point that I'll kind of bring up just to go back to the position sizing. And this is definitely something I've experienced in my own portfolio when I really started kind of reflecting back on, well, where is the position sizing sit in my current portfolio from my various assignments? Because I've been playing a lot of earnings lately. And I'll look at the where I entered a particular position, right? So when I sold those puts, when I sold that strangle, the position sizing or the buying power consumed in there. My particular account was, somewhere around 2% of my portfolio balance for the particular trades, and I got assigned. And I looked, recently, and even after assignment, the trades continue to work against my favor, and some of the position sizing of those underlyings after being assigned are now in the realm of 15%, 13%, 18%, and that's just no good for exactly what we're kind of talking about here. So I guess I am guilty of my own thing where I size the trade based on the capital requirements to execute the trade, and didn't really forecast. Now I'm not necessarily in trouble, but if I put too many of these things on and I get too many of these assignments, I won't have that margin to hold those assigned positions. And so that was just kind of a little bit of a reflective moment for me to realize, hey, I took these assignments and I never really updated my brain to tell my brain how much of the portfolio this is now taking, where I have gotten assigned. And so I'm really kind of looking back at some of those and trying to think and plan a little bit better of a strategy post assignment. Like, how long do I hold these things post assignment if I'm not getting that price appreciation back close to my strike price where I can sell those covered calls? Like, how do I not ride these things to zero? What can I tweak about it? Because it is a gap that I think I uncovered myself in kind of doing some reflective ness on my recent strategies.
Yeah, one other thing I would add, as a final thought as well, is I think the exercise you did was very interesting, as far as challenging your personal strategy, challenging your bias. And I would say, I mean, you could even, it's probably still applicable to you, Sprocket, but also to anybody else, that another, I think, superb resource for that exercise is go fire up whatever your favorite LLM is, and have a conversation. They, a lot of the LLMs, Chat GPT, Grok, whatever, they can sometimes have a bias to, to want, not, I mean, I don't want, not please you, but they have they pick up your bias and they kind of, read that into their response. So don't let them know your bias, and, go into a conversation and say, hey, what's wrong with this particular strategy? As either one exercise, or if you're brand new getting into this, and you don't want to play games with it, like, just go in there and say, what's the worst case scenario if I buy this naked put, if I buy this option, or if I sell this naked option, what's the worst that could happen? And give it details, give it a screenshot of what you're looking at. And it's insanely helpful because it'll conversationally break it down for you. So I think that's a great resource, that's kind of unique to this moment.
Yeah, honestly, I really think challenging your perspective and your stuff is a very, very healthy thing to do. Like, go on the hunt for the other side of things. And I think what you'll find when you go through that is it will actually strengthen you, because that's one of the things that fascinates me about markets. Right, is there is no one right way to play the market. We've talked about this before on the show that you even in selling and buying options. I, the option seller, could sell to you, Viper, the option buyer. You buy the option, and we both can win. Like, it doesn't have to be a I win, you lose, I win type of situation. And that's the part that is absolutely fascinating to me about the markets is you can have completely different strategies. In fact, even opposing strategies. And in the end, both sides can win. And what it really comes down to is you understanding what fits your trading style and your preference. And I think the only way for you to really start to discover that is to really then start challenging your side or your thought of things with something else. And there's nuggets that you'll pull out of there and you'll start to understand a different perspective. That other perspective isn't right, it isn't wrong, it's just different. And so there might be elements of that that is appealing to you, and maybe you adopt them and add that into your little trading stew. So I really, really, really encourage you guys to take a particular, once you have a thesis, once you have something that you're kind of going down, instead of looking for more information to back that up, start looking on the contrary. Why not do this? Why not do this? And I think you'll start to learn some stuff. And so I do think it overall makes you a much healthier and robust trader. And that brings us to the end of this week's episode. Really, the underlying takeaway here is, challenge your perspective, challenge your bias, but always, always remember, no matter what position you take, no matter what strategy you deploy, no matter what, the underlying theme that really can keep you in the game is position sizing. Know how much capital you're putting up in a particular strategy. Understand the impact if that goes south. What's the worst case scenario? Because if you appropriately position sizing all of the stuff that you put on, it doesn't really matter as much about whether that one thing is going to be a winner or going to be a loser, because if you appropriately compartmentalize all those things into smaller bite-sized chunks, where if one of them falls off the table, it's not going to ruin the whole lot. And I think putting that and making that front and center to everything you do really helps you keep in the game long term. And it really is an infinite game. There is no end. The only end is when you run out of resources to play the game. So keep the position sizing correct relative to your portfolio so that if things go south, if things go the worst case scenario, you don't blow up your portfolio so that you can't participate anymore. And constantly be out there on the lookout, the hunger, the search for the counterpoints to your particular trading bias. Challenge yourself, challenge from other perspectives. If that either will teach you something new or it will strengthen your current strategy and strengthen your current belief, either way, no matter how it turns out, you'll likely be a more healthier and robust trader in the end. So good luck out there, have fun, and remember, think outside the block.